Have you ever wondered why most traders lose money? You might think it's because their strategy is flawed, but that's not the whole story. The real reason is often much simpler. They don't understand market structure. Think about it this way. Market structure is the language of the charts. It tells you exactly who is in control of the price at any given moment. The buyers or the sellers. It's the framework that everything else is built on. Once you truly grasp how to read it, you stop making blind guesses and start making confirmed, high-probability decisions. It's the difference between gambling and trading with a real edge. You'll stop feeling lost and start seeing the market with incredible clarity. So, if you're tired of being on the wrong side of the trade, stick around, because we're about to dive deep into the one concept that can completely transform your trading results. So, what is market structure, really? At its core, it's incredibly simple. Market structure is just the sequence of highs and lows that price creates on a chart. That's it. Let's break it down. In a clear uptrend, what do you see? Price makes a new high, pulls back to create a low that's higher than the previous one, and then pushes up to make another new high. This creates a pattern of higher highs and higher lows. This sequence isn't random. It's a clear signal. It shows that buyers are dominant. They are consistently willing to pay more for the asset, pushing the price upward with strength. On the flip side, in a downtrend, you'll see the exact opposite. Price creates a new low, pulls back to a high that is lower than the previous one, and then falls again to create another new low. This pattern of lower highs and lower lows tells you that sellers are in control. They are aggressively selling, driving the price down. This sequence of highs and lows is the footprint of institutional money. It reveals who is winning the battle between buyers and sellers, and your job as a trader is to simply align yourself with the winning side. It's not about complex indicators. It's about reading the raw price action. Now, let's talk about the biggest trap that ensnares retail traders and causes them to consistently lose money. Most traders have been taught to see a pullback and immediately think the trend is over. They see a strong uptrend with a few red candles, and their first instinct is to short it, thinking they've caught the top. Or they see a powerful downtrend with a small bounce, and they rush to buy, convinced they've found the bottom. This is a catastrophic mistake. Here's a crucial truth you need to understand. Pullbacks are not reversals. A pullback is a healthy and necessary part of any trend. It's a moment of profit-taking or a temporary pause before the next major move. What are the big institutions doing during these pullbacks? They aren't panicking. They're using that dip in price as an opportunity to reload their positions at a better price, adding more fuel to the trend. This is precisely why so many retail traders feel like the market is moving against them. They pull back and then watch in frustration as the market roars higher without them. They get stopped out, and then the trend continues in the original direction. It's because they're fighting the dominant flow of money instead of trading with it. This brings us to one of the most critical distinctions in trading: the difference between a simple break of structure and a true market structure shift. They might look similar at first glance, but they mean completely different things, and confusing them will cost you dearly. A break of structure is often temporary. For example, in an uptrend, price might briefly dip below the most recent higher low. Many traders see this, scream reversal, and immediately jump into a short position. But then, price quickly reclaims that level and continues pushing higher. This is often a liquidity grabber, deliberate move by institutions to trigger stop losses and trick traders into taking the wrong side before the real move happens. A break is just noise. A true market structure shift, on the other hand, is a fundamental change in market behavior. It's not subtle, it's powerful. You see what's called displacement? This is when price moves with extreme speed and force in the new direction, leaving behind large, inefficient candles, often called fair value gaps. This explosive move shows a real transfer of power, and critically, it's followed by confirmation. The market doesn't just reverse and then go back. It establishes a new pattern. After the initial forceful move, the pullbacks will start to respect the new direction. This combination of displacement and follow-through is how you distinguish a fake-out from a genuine, tradable change in trend. So, how do we use this knowledge to confirm the market's direction and trade with confidence? The number one rule is this: never, ever trade against the dominant market structure without clear confirmation of a shift. If the market is making higher highs and higher lows, you should only be looking for opportunities to buy. Don't try to be a hero and call the top. Wait for the market to tell you it's ready to reverse. When a true structure shift occurs, you'll see the character of the market change completely. Let's say we were in an uptrend. After a shift to the downside, the pullbacks to the upside will become weak and shallow. They won't have the same power they did before. Conversely, the moves to the downside, the new impulses will become strong, fast, and decisive. You will see that displacement we talked about. The roles have reversed. Sellers are now in control. That is your confirmation. Once you see this change in behavior, you can then wait for a weak pullback and look for an entry to join the new down. This is how you stop guessing and start reacting to what the market is actually doing. You trade with the flow, not against it. By the way, I know this can be a lot to take in just from a video. Seeing these concepts applied live on real charts is where it all clicks. That's why I break down market structure live every single week inside our free Discord community. We analyze charts together, I answer your questions, and we find trading opportunities in real time. If you want to accelerate your learning and see exactly how this works, the link to join is right in the description below. It's a great community, and I'd love to see you there. So, let's wrap this up. Remember the most important lesson about market structure. It doesn't predict the future. Its power lies in confirmation. It provides a framework that allows you to understand the current market environment and make decisions based on evidence, not hope. Stop trying to guess where the market will go next. Instead, be patient. Wait for the structure to show you who is in control. Wait for that clear shift in behavior. Wait for that displacement and confirmation. When you see it, you can trade with clarity and confidence, knowing you have the wind at your back. Master this one concept, and it will change everything for you. Thanks for watching, and don't forget to subscribe for more content to help you become a smarter trader. See you in the next one.